It's almost 1 p.m. in Sydney, 11 a.m. in Hong Kong and Shanghai. Welcome to Bloomberg Markets Asia. I'm Paul Allen. Here are the top stories. The yen's weakening extends, pairing a surge on suspected intervention that saw the currency gain 3% in just minutes. Asian stocks gain as Fed Chair Powell sounded less hawkish than expected. The Hang Seng poised to enter a bull market with the longest win streak since 2018. And we speak to German software giant SAP about how it's helping customers utilize AI and cloud technologies. Ahead of that, though, we're going to be joined by Rebecca's head of Asia Fixed Income with her strategy off the back of the Fed's rate outlook. First off, though, let's check on how markets are doing. We don't have any trade in China today, but Hong Kong is up and running pretty strong. What are you watching, Avril?
Yeah, we're seeing a lot of upside in Hong Kong, but in general, it's a bit of a mixed bag across the Asia Pacific. Although we are seeing some gains, it seems here like investors were bracing for a more hawkish Fed. What we got was a Fed that downplayed that the imminent move would be one of a rate hike, and also those signals that it will slow the pace of the shrinking of its balance sheet to ease the pressure on money markets. Yet Powell also signal that, while keeping those rate cuts on the table, they might not come so soon, especially given how he sees inflation in the country. Have a listen.
In recent months, inflation has shown a lack of further progress toward our 2% objective, and we remain highly attentive to inflation risks.
Lack of progress on inflation. That is the highlight there. So that's why perhaps we're not seeing that much convincing moves to the upside. The Kospi is down. We're seeing Nikkei futures also pointing to a slight gain when markets return from that lunch break. But as I say, the focus has really been on the Hong Kong stocks. Quite a rally, a world-beating rally, despite the crucial pillar of support today, mainland investors, because of course, China, as you say, is shot. And a lot of the upside that we're seeing might be thanks to what investors are expecting, that optimism from Chinese tech names earnings that are due in the middle of the month. And we also have the Hang Seng that is poised for its 8th winning session. This would be the longest streak since 2018. It's also edging towards about 20% gain from its most recent low. So that would meet the technical definition of a bull market, although, of course, this is from a very low base. Now, among the currencies, we're also keeping a close eye on the Korean won. Don't forget, we did get some of the inflation numbers out of Korea today, and the weakening in general, though that's not what we're seeing today, of the Korean won might pose some challenges for the BOK in its fight against inflation. The CPI print did show a cooling that was better than expected. Now let's take a look as well, if we can, on the Japanese currency, because it's not just the Korean won that we are focusing on. It's really been about dollar yen. And remember how earlier in the week we saw that move sharply. More recently, the yen had weakened towards the 157.5 level after Powell spoke, and then a sharp move towards the end of the New York session towards 153, smelling a lot like intervention. The currency chief saying he cannot say anything about intervention, but note here that we are seeing that weakness, and it's those yen bears really testing how far Japanese officials will go in defense of the currency, Paul.
All right, thanks very much, Avril. We're getting some breaking news from SK Hynix right now. We've got news that memory chip orders almost now fully booked until 2025. SK Hynix says it's also going to commence mass output of next-gen high-bandwidth memory chips in third quarter. This is according to exclusive reporting from Bloomberg. We're seeing SK Hynix a little bit off the pace in Korea today, but the news being reported, SK Hynix will aim to begin mass production of its next-generation memory chip in the third quarter, seeking to capitalize on that surge in demand for semiconductors, which are, of course, essential to AI development. But it's also saying that 2025 production for that high-bandwidth memory almost fully booked. So that really does underscore not just the boom in intelligence services, but also just how much demand is outstripping supply at the moment. All right, for more, let's bring in our MLive strategist, Mark Cranfield. Mark, I want to start with that rally in Hong Kong. We've got stocks up for an 8th straight day and tech performing particularly strongly.
Yeah, there's a couple of things which make it all the more impressive. As Avery was saying, China is out today, so there's no inflows today from the mainland, which obviously would normally be a good factor for them. Also, it's impressive because if you look at the performance in the last couple of weeks, it's been against the trend of what we've been seeing in the United States. So even though S&P 500, NASDAQ contracts have gradually been coming lower, Hong Kong markets have done pretty well in the face of that. So that's, again, that's a good sign. Clearly, there's some optimism here about what's coming up in terms of tech earnings. We've got the big ones. We've got Tencent, Meituan, Alibaba, Xiaomi are all coming up within a very short period of time. They report within 2 days of each other. And given what we've seen from the US tech companies and some around the world, even that news you just broke about Hynix there, that is also going to be a positive for Hong Kong as well. Because if they see improvements there, they'll translate that as being positive for their own companies as well. So certainly there's optimism that when the first quarter results come through for the big Hong Kong tech companies in a few weeks' time, that is going to be another booster. It may well be we'll be able to keep the good move going until we get there. Then the real test will come. People want to see the hard numbers. And if they genuinely beat, then maybe the rally can continue.
All right, MLive strategist Mark Cranfield is going to stick with us. We'll talk about the Fed, the Bank of Japan in just a moment. We do have plenty more to come. This is Bloomberg. All right, well, we talked a little bit about that rally that we saw on the Hang Seng. Tech stocks doing particularly well. Let's get back to our MLive strategist, Mark Cranfield. And Mark, seems like Hong Kong didn't really get the memo from the Fed. It was a bit of a masterclass into how to say something without saying anything at all. The Fed promising it's not going to lift rates. Is that pretty much what passes for dovishness these days?
I think between the lines, it was not a dovish outright statement as such, but it was a lot less hawkish than people had feared going into that FOMC decision. And then the two highlights, obviously, are one, as you say, you mentioned the fact that rate hikes are not really on the table, but probably more importantly, for the bond market especially, the talk about the QT. So the fact that they're going to reduce the speed of the balance sheet rundown. So it's going to come down to just a pace of 25 billion a month from currently 60 billion. And that's a much bigger change than people had expected going into the decision. So that's a good sign for the bond market. It also comes in more quickly as well. It's going to start from June. So they brought it forward. So in a way, that's like a kind of a stealth easing in itself, because it takes a lot of pressure off the US bond market. If it does that, that's also beneficial for the equity market as well. So from a portfolio point of view, if you're an asset investor in the US, you got some relative good news there from the Fed and from Jerome Powell. It's not obviously as encouraging as saying interest rate cuts are going to start very soon, but at least under the circumstances, it was a much better outcome than people had seen before the Fed meeting.
Yeah, perhaps not the news that policymakers trying to defend the yen in Japan were really looking for either. And we saw another big move today, raising the question that we've had 2 interventions now this week. But the question, I think, is, where does the ammunition for this come from? I mean, it comes from foreign reserves, but how much ammo does the BOJ have? How many more interventions could we potentially see?
They could probably do quite a bit more here. There's been talk that the amount of ammo they have is somewhere in the region of 150 billion US dollars in total, without going to ask the authorities, the government, for even more, which they could do. But let's say they start from that premise. Well, it looks as though they've spent around about 35 billion on Monday. They probably spent a bit more last night. So they're probably not even halfway through that current amount of money they have for intervening. And they do need a lot, because these days we're talking about a foreign exchange market which runs at about $7 trillion a day. So you can see you need to throw a lot of money at it. The last time the biggest move they had came with 60 billion worth of US dollars sent into the market. So we're talking about very big numbers. It needs to be built up over a period of time. Now we're going into a long weekend for the Japanese. They're off on both Friday and Monday. They had quite a bit of success, it seems, on Monday, which was also a holiday. So people are really on the edge of their seats here, expecting there's a decent chance they will add to what they've been doing this week, possibly tomorrow, if not again on Monday. And really the aim here is to get dollar yen below 150. If they can do that, it probably have a little bit of momentum in itself, because traders will want to go with the flow. If it doesn't go below that line, it's going to be much more difficult for them. And of course, as you said, they didn't get a lot of help from the Fed last night. They would have probably hoped for a little bit more. In the meantime, you can expect that they're probably going to push a little bit harder just to get traders on their side.
All right, MLive strategist Mark Cranfield there. Let's now get a little bit more on those moves, or lack of moves that we saw from the Fed, but the moves that we did see from the yen. Thha Cha, head of fixed income Asia at Rebecca, joins us now. Thha, I just want to start off with what we heard from the Fed today. Really not a lot of new information there, remaining data dependent, ruling out a hike. Have you given up on the idea that we're going to see any easing at all in 2024?
I guess there's still some possibility, but definitely pushed out to probably the very later part of the year, given how much data that is going to require them to be able to move anything. But I think the thing that we actually probably need to refocus now is obviously the inflationary pressures there, but also how the economy is doing. There is definitely some signs that it is beginning to be, there is some pressure on it. And I think that is equally important for the Fed to make sure that we don't have the economy kind of slowing down so that we have to worry about stagflation in any form.
Yeah, stagflation definitely becoming part of the conversation again. Data dependency, that's the buzzwords that we keep on hearing. But we're going to get an important piece of data this week with the US jobs report. What are you anticipating there? Do you think it's going to change the picture at all for the Fed?
I think, of course, it's going to be really quite important, because you've got one end of the equation, the inflationary pressure doesn't look like to be receding. If we get a very difficult jobs number that indicates that actually the inflationary pressure is actually also negative for the jobs market, that, so which but actually not necessarily helpful for productivity and others, so that's going to be difficult. So I think a number that's too high or too low is going to be probably, and the one that's kind of within the range is probably the best for the market, I think.
Of course, the yen very much at the behest of what happens with that data, what the next move from the Fed is as well. And we've got a chart here on the Bloomberg terminal that just shows some of the wild swings that we've seen in the yen this week, from 160 to down where we are now at 155.94. So we're looking at maybe two interventions now. But I just wonder, how effective do you think this sort of thing is, particularly considering the yen is just hostage to macro events that are beyond the control of the Ministry of Finance?
It is, and I think this is about as much dollar strength than it's about yen weakness. But however, there is still some policy that can actually be helpful for the market is looking for, right? Just the normalization of kind of the JGB market, and how effective that we are going to have rates that are moving in the opposite direction, hopefully as the Fed. And I think this is where the economics have to actually come into it as much as actually rates action. And I think this is where people are still very on edge about the yen, because that picture is not very clear. What kind of rates can be normalized, and that actually has that impact on the economy? And that's still very much untested at this moment. And I think that's why we'll continue to see a lot of volatility as the market tries to figure that out.
Oh, yes. We might have an opportunity to return to yen policy in just a moment, but I just want to get across a big move that we're seeing in China Vanke in Hong Kong at the moment. We've got that stock of the property developer pushing higher by about 14% right now. So a big move from China Vanke, admittedly off quite a low base. Where do you think we are in terms of China property at the moment? Because these problems haven't really gone away. How are you explaining these outside moves that we're seeing right now?
I I think first of all, we come, as you say, come from a very low base, right? And it looks like people feel like the authorities are actually trying to arrest the underlying issue of some sort of inventory and making sure that we don't kind of double dip again. So I think that's why the market is generally a bit more positive. But I think just the cyclical upturn in itself, as we've kind of been seeing for the last few months, is actually helping the market overall from a very kind of bearish scenario within China to somewhere where now it seems as the stabilization has come through and some cyclical upturns. And I think that's in a place where there's very few places to hide and valuation still relatively attractive. I think that's what's causing some of the moves that we've seen recently.
Yeah, we also got the news today that the third plenum is going to take place in July. Now, it's interesting because this is an off-schedule year for the plenum. We're not meant to have one. The other thing we don't have is an agenda at this stage, which is a little bit unsettling for markets. What do you think is going to come out of this in terms of policy?
Well, I think they made it very clear they're using this to front run things that they may have actually thought about doing anyway, just a bit of ahead. I think both maybe pushing on both monetary and fiscal policy with this momentum kind of, pushing on this cyclical upturn. So I think this is why the market feels like, okay, they're taking action and maybe taking action when the market is already on their side. So that actually could be quite nice from both sides of converging, and as it from a very low base. So I think this is why I think the market is getting a little bit more excited about that. This could be pushing on a trend that's already there in the market.
In terms of monetary policy, though, do you think the PBOC's appetite for easing is perhaps somewhat blunted by the weakness that we're seeing in the yuan right now?
Yes, and like everybody else, right, the U.S. policy is not helping anyone taking the policy in the direction that they would like it to be. But having said that, I think with the yuan, pretty much people accept that, that they're going to have to try to cut, and they may do, and I think that's kind of priced in. So maybe the pressure on the yuan may be less than some of the other currencies out there versus the dollar.
All right, well, you specialize in fixed income. I'm just wondering how you're managing your fixed income portfolio in Asia under the current environment, especially when it comes to credit.
Yeah, but I think definitely credit spreads have actually, really outperformed this year, probably at some of the tightest levels. So I think here we really are focusing on an up in quality trade because, I think the market is very kind of already very optimistic on spreads. And I think secondly, differentiation. We're also focusing very much on bottom-up ideas because the market doesn't seem to be as differentiated as it was only several months ago. And I think we're still looking for bouts of volatility, which we still expect to be kind of as good opportunity to buy on dips. And then we do see bouts of volatility every now and then, given the macro conditions.
All right, Thha Cha from Rebecca, thanks so much for joining us with your insights. We do have plenty more to come. This is Bloomberg. All right, so let's take a look at how we're tracking on some of these Hong Kong benchmarks at the moment. The Hang Seng Index having a pretty good day, really, considering the rather, nothing burger statements that we had from the Fed a little bit earlier on. Other markets looking much less exuberant than this. We've got the Hang Seng better by 2.3%. No trade in China today, public holiday there, but the Hang Seng Tech Index really having an outstanding day, better by 4.3% at the moment. And China Vanke, as I mentioned earlier, also performing very, very strongly. That stock right now better by about 14%. The property index more broadly, just a shade less than 3% higher. Well, China's top climate chief is warning the climate fight is going to be too costly without Chinese products. Liu Zhenmin spoke exclusively with our chief North Asia correspondent, Stephen Engel, and says Western decoupling could cost the economy trillions of dollars.
If the Western countries continue to insist to decouple from the imports of the China products for clean energy, it will cost the world for maybe additional $6 trillion. It means a 20% increase of the overall cost. We need to maintain the low cost. Otherwise, nobody going to afford for this energy transition process.
And officials in the U.S. and Europe claim that China is giving unfair subsidies, and that has led to the situation we're in right now that could distort global trade in these clean products. How do you respond?
I think if both U.S. colleagues, European colleagues, going to talk with our Chinese enterprise, you can see all these renewable energy equipment technology, they are innovated and developed and manufactured by our private companies. This is very unique, very unique. I think private companies normally, they don't receive any government subsidies. I think we should really highly appreciate the dedication and contribution by these enterprises. So after more than a decade of their hard efforts, now we have cheaper both solar and wind products, which were now affordable to start the energy transition. I think that this is good for both for China and both for the world.
While we're talking about overcapacity, we have to also talk about the domestic economy here because we've been seeing profitability sink at a lot of these solar companies and EV companies. Price wars are driving down their margins. What does that do to the climate fight? If the world is bifurcated on trade,
we can talk about capacity in two different ways. For the global demand, as well as China domestic demand, we're still on high demand for the renewable energy products. Because for the Chinese government, I think we're determined to increase our renewable energy capacity to a high percentage, maybe over 80%. I think for the next decade, we're still in the process of increasing our renewable energy capacity. Globally, I think that's much slower than what the Chinese were doing. So there'll be high demand for the renewable energy. For the so-called overcapacity among the manufacturers, among our Chinese manufacturers, it's a temporary issue. It'd be also good that it be through this kind of competition, they can continue to improve their manufacturing and make much more better products.
That's China's Special Envoy for Climate Change, Liu Zhenmin, speaking exclusively with Bloomberg's Stephen Engel in Beijing. All right, let's take a look at how China EV stocks are moving. Particularly want to take a look at NIO. It's jumping pretty strongly at the moment, better by about 22%. That's off some of the session highs that we saw earlier. Now, NIO's reported a 32% jump in vehicle deliveries in April compared with the previous month, also announcing the shipment of a new model on April the 25th. So rising tide floats all boats. We got Xpeng and BYD also in positive territory there. What's not in positive territory? Oil. That's slipping back just a little. Big jump in US crude inventories weighing on prices there. All right, still to come. German software giant SAP is eyeing $1 billion investment on AI over the next 2 years, and their chief revenue officer is going to join us for an exclusive interview next. This is Bloomberg.
The whole game plan is basically unchanged. We're going to keep rates here until we're highly confident that we're going to get inflation down to 2%. No hint whatsoever of a rate hike.
I think there's a lot of relief here that the chairman stayed true to what we've seen from this chairman.
I think Jay Powell was particularly disciplined here. I think he stayed on message very well. There's a clear bias towards easing, and he stuck to that.
They've left wide open the question of why has progress been less than they expected on the inflation front.
The Federal Reserve is not living up to the commitment on inflation that other central banks are.
Let that tight policy work for longer. I think that's about as far as they're ready to go today. That's hawkish in May. We'll see what hawkish might look like in June.
This is really good for the markets because here's a Fed that's telling us, look at the longer term. Look where inflation was and look where we've gotten it to. Don't worry about the last couple of months. We'll see what happens there.
Some of our guests there reacting to the latest Fed decision, which was to keep rates unchanged, very much as anticipated. Avril, let's check in on how markets are doing in the wake of that. Not a lot of movement, really, except for Hong Kong. What's going on?
Yeah, a lot of upside in Hong Kong, but we know how Japanese markets have been moving sideways for much of the session. I think it's really following on from the month of April where we saw stocks there underperforming, and a lot of it had to do with how the Fed pivot, rethink was going on. So today is a bit of more of the same, because don't forget what we got from the Federal Reserve is, yes, it downplayed that the imminent move is for one of a hike, but given what Powell had to say about inflation, it's not like we're going to see rate cuts anytime soon. So this is what we're seeing in Japanese equities as we come back from the lunch break. Of course, we've been keeping a really close eye on the yen. Earlier, it moved to 153 after hitting about 157.5. Smelled a lot like intervention, but now pushing above 156 is those yen bears really testing how far Japanese officials will go in defense of the currency. Of course, the fundamentals are on their side. It's that yield gap that are pushing things along. But let's talk tech, because that's in focus today. We got SK Hynix saying on its AI memory chip, those orders pretty much fully booked until 2025. AI boom driving a lot of that demand. In terms of mass production of some of these chips is looking at the third quarter. And again, this is really a sense of how we're seeing the AI sentiment coming into the market. So SK Hynix, which declined earlier, managing to pare some of those losses on a day where tech is not really performing very well in the MSCI Asia Pacific, except if you're looking at Hang Seng Tech. Chinese tech names gaining a lot of ground today, that optimism coming through about their earnings coming up shortly. Paul.
All right, thanks for that, Avril. I want to bring you some live pictures now from Kuala Lumpur, where we have the Microsoft CEO, Satya Nadella. He's making an announcement in Malaysia. He's saying that Microsoft's going to invest $2.2 billion to build digital infrastructure in Malaysia. So it's going to spend that money over 4 years, and it will be building infrastructure for its cloud computing and, yes, artificial intelligence services. So Satya Nadella, they're taking the stage in Kuala Lumpur with that $2.2 billion announcement. Well, Europe's biggest software firm is looking to migrate customers from its legacy on-premises system to the cloud. SAP's offering businesses AI services to sweeten the deal, and it plans to invest more than $1 billion into the technology over the next 2 years. And joining us exclusively right now, we have Scott Russell, Executive Board Member and Chief Revenue Officer at SAP. Scott, thanks so much for joining us. Let's talk a little bit more about the detail of this $1 billion investment you're making in AI over the coming 2 years. Can you give us some specifics about what exactly you're developing and what the applications of your developments are going to be used for?
Sure. There's no doubt that the growth of AI, it's real. It's not a hype. It's real, and it's here to stay. And for businesses who are already on that growth journey, on that transformation journey to the cloud, which we've seen in our results, you saw in our Q1 earnings, growing at 25% at constant currencies. Here in Asia Pacific, Japan growing at 35%. Businesses are moving to enabling capabilities in the cloud, which you obviously need. And that means that businesses can then use and leverage the AI. So why is AI so relevant to us? Because we are the business applications leader in the planet. Most businesses, their most powerful and their most important data that they run about their customers, their people, their suppliers, their financial, all sits within their SAP platforms, and they want to unlock the capability that generative AI brings to their daily tasks, their business processes. And that's what SAP is doing. We're bringing that to life for customers around the world, whether it be around sustainability data, whether it's helping them in their supply chains and making it more resilient, driving better financial performance, or simply serving their customers more effectively, pervasively embedded into our applications and enabling them to unlock that data together with publicly available information to their business value.
Of course, one of the stories we're always reporting on, and we mentioned it just a short time ago with SK Hynix making that announcement that it's basically sold out of all the chips it's manufacturing until 2025. So a lot of challenges around getting some of the hardware needed for these sorts of developments. In terms of acquiring what you need, how much bang does $1 billion get you?
Well, it's not. It's been a journey that we've been on for over 10 years, Paul. So we've got over 27,000 customers that are leveraging our AI capability. Companies here in the region like Cinemas and Hanwha, or business leaders. I was in Australia earlier this week, AusNet, Coles, and others that are able to leverage this. But the beauty of the AI capability of SAP, which I think the market is demanding, is there are so many large language models. There's so many providers out there. We're able to abstract that, and we are a partner orientated, so we can leverage that computing power, leverage the best practices, but then do it in a secure, reliable way for our customers with that mission critical data. So we're able to do it not only in leveraging the best capabilities that companies like Microsoft and many others who we partner with, but also we're able to then help them manage their TCO and their cost of compute, because you're right, the demand is very high, but so is the expectation of results. And we're all about business value. How do you use this capability to drive business outcomes? And obviously we see a huge potential with that, including here in Singapore. We've got a large lab that we've got for mission critical capabilities of AI. So we've partnered with the EDB to leverage the talent, the innovation right here in Singapore to serve not only the Asia Pacific region, but globally. So leveraging talent pools around the world to serve the market.
I mean, is that where you see the biggest growth? You're Europe's largest software company, but is that not necessarily where the strongest growth is? Are you looking more to Asia?
There's no doubt that Asia has been the growth engine for SAP for a number of years. So as I mentioned before, growing at 35% in cloud revenue. The beauty is our customers around the world in North America and in Europe are also growing at similar pace. I think what is really important is businesses are global by operation, but they want the data to be governed, resonant, and managed in a really secure way. So not only do we see the growth engine of Asia Pacific and the businesses here, but as they move into their global operations, moving into different markets, they can leverage that capability in a secure manner. And I think one of the challenges around AI from a business standpoint is the ethical and the reliability standpoint. So not only are they using their SAP applications and data for their core mission critical processes, but they have the same comfort that when they apply generative AI, that they have the same guardrails that SAP puts in place, making sure that whatever we do is sustainable and beneficial, and also aligned to the regulatory framework, which is a dynamic place right now around the world, including here in Asia Pacific.
Well, for SAP specifically, your cloud revenue's up. There's no doubt that this is very much a growth area for the business. What's your outlook for this sector in the context of the AI boom?
Yeah, we've been on a growth journey for many years now, and Q1, as you point out, was a very strong quarter. And again, it just reinforced businesses want to do several things. First of all, they want to transform, be able to have resilience and power in their core mission critical operations. And that's what we provide. Business capability to help them to react and respond to the needs of today and tomorrow. Companies like Cinemas, who have got a great SAP history, but they're leveraging our cloud capability to do the next iteration of transformation. But they're wanting the infusing of the generative AI into their core business process. So being able to use that to leverage more insights, whether it be automating their invoicing and document management, being able to use our visual inspection of the supply chain for defects and inventory, being able to then build and then transform into new businesses as they expand around the world. Even companies like Coles, who have got a core capability of running their operations on SAP, but then leveraging the AI capability to be able to provide a better service to consumers in Australia. All of the examples is embedded into core applications. And I think businesses are now saying, I don't want to build my generative AI separately. I want it infused into the way I do my business on a daily tasks. And that's what SAP brings. So the outlook is strong. We're certainly optimistic about the growth for SAP, not only in the cloud, but to be the #1 business application company and #1 in business AI.
We're also living in a complex geopolitical environment where we have the US and some of its allies really trying to squeeze China on chips development, on its own AI journey. To what degree is this impacting the way that you're conducting your business?
There's no doubt that the geopolitical landscape is one that is difficult to navigate for businesses. And I guess one of the things that SAP brings is because we're a global operation, we've been supporting not only Chinese businesses, but over 100 countries of local operation. One of our core value proposition is to be able to ensure the business applications meet the regulatory requirement, including the evolving. And when you think about generative AI, data sovereignty, data residency becomes a critical element in what businesses are looking for, as well as regulators. By our local proximity in markets like China, here in Asia and around the world, we're able to provide that assurance to companies as they move into or operate in those markets, that we can help provide that resilience for them and navigate those changing geopolitical environment. The good news is our investments in generative AI will not only benefit local businesses, but businesses who are expanding globally, and provide that assurance that as they navigate the geopolitical and macroeconomic uncertainty, they've got a mission-critical platform that brings the best capabilities, that not only wins, but also makes sure that they can adapt to the regulatory changes that are no doubt hitting us all.
All right, Scott Russell of SAP, thank you so much for joining us today with your insights. And on the topic of tech, let's take a look at the Hang Seng Tech Index. It's definitely the bright spot in Asia today. We have the broader index better by 3.5%, although it's giving up some of the gains that we saw a little bit earlier on. So a very strong day for the Hang Seng Tech Index. And for more on this rally, I want to get over to Bloomberg Intelligence senior analyst Robert Lee. Robert, some of these names were pretty beaten up, and as I was just discussing there with Scott Russell, a lot of China tech names have been squeezed by US curbs. How do you explain this sudden rally? Is it just they've got too cheap to ignore?
Hong Kong market has underperformed for some period of time. So I think since the beginning of this year, really, the index has bottomed out, and we've seen some sort of bottom fishing coming in. So that's something that's been apparent really for the last 2 or 3 months. The market and the index has begun to rally, and that trend seems to be continuing at the moment. So whilst the growth outlook for China tech stocks and HS tech stocks might not match its Nasdaq peers, and particularly the Magnificent Seven, the valuations these stocks were trading on were significantly lower. So I think as well, if you look at Nasdaq and with the index, potentially topping out, and with expectations potentially having got a little bit too high, people are looking for areas where there's still growth to be had at maybe more reasonable valuations. So I think that's one of the key reasons. Very briefly, as Avril Hong said earlier, we're heading into earnings season, so there's expectation that Q2 outlook for a lot of companies should be fairly decent. But as I said, I think it's the valuation which has attracted people back to this index and this market at the moment.
And where's the demand coming from? Is it Chinese investors, or is it coming from offshore?
I think, Asian markets in general are quite retail driven. So absolutely on the retail side and the domestic side, there is that. But, China's been, I don't want to use the word off limits, but it's been on the periphery, and due to the increasing geopolitical tensions has been something a lot of fund managers have not been looking at, and some of them are actually forbidden due to their internal rules from adding to China positions. So I think we are seeing incremental signs of interest from foreign investors coming back. But yeah, I would say in fairness, this is still largely a domestically driven rally, which may well raise questions about the sustainability of that rally. But things are looking good at the moment, and with high expectations into the Q2 guidance, then in theory things could continue to evolve in a positive way.
Well, we're, of course, on the eve of hearing enough from another member of the Magnificent Seven as well. We're going to get results from Apple in US trades early on. We're not expecting great news here, perhaps maybe sluggish earnings. Of course, China's been a little bit slow. But is generative AI on iPhones, is this the next big thing from Apple?
Well, Apple, as I think yourself and your viewers will appreciate, has been a bit behind the curve on that. that may well be to their advantage in the long term. There is some speculation in the market that they could be partnering with Google and maybe using their technology to help narrow the gap on the AI side. The potential sort of advantage for them with that is they have foregone spending tens of billions on CapEx, unlike many of their other Mag 7 peers. But I think the core focus for Apple will remain the product business, and particularly iPhones, and specifically in China, where it's likely we're going to see ongoing weakness for the foreseeable future. So I think for the results that are coming overnight, the focus will most definitely be on the product area. And whilst I think my US colleagues think the revenue overall for the quarter could come a little bit ahead of expectations because of better pricing on some of their premium phones, the focus is all on the guidance, really.
Just quickly, you mentioned product there. We're going to get our first look at sales of the Vision Pro. Are we expecting great things or just a blip?
Being a cynical, weather-beaten British person, I think this is very interesting for your technophiles and your Apple files. Is it likely to evolve into a mainstream product in the long run? I think that's highly unlikely. Is it likely to be a major earnings driver for the business again in the long run? Again, I think that's highly unlikely. So great if you're an engineer or someone who loves tech, but this is not a mass market product in my view.
All right, Bloomberg Intelligence senior analyst Robert Lee there. Still to come, Indian conglomerate Godrej gets split into two to maintain family harmony. We're going to tell you who's getting what up next. This is Bloomberg. All right, welcome back. You're watching the India Focus. What we're looking at here is shares in the various members of the Godrej family of companies. Of course, this is a 125-year-old diversified conglomerate. It's involved in all sorts of things from consumer goods, financial services, real estate. We saw a bit of a mixed bag at the moment. Property's weaker by 1.5%, but the rest of that bag of stocks doing pretty well. Now, a lot of change in the wind at Godrej. Here to walk us through the details of those changes is Bloomberg Conglomerates reporter PR Sanjay. So, PR, we're hearing that this group is going to be split up to maintain family harmony. I mean, what's the business case behind doing this?
Paul, you're right. It's a few points. One is like Godrej Group is one of the oldest conglomerates in the country. Number one. And this is also a landmark deal for the Indian conglomerate landscape because this has been done very amicably, in a very friendship manner to maintain the harmony between groups, various companies, listed companies across. So to split, to give more clarity, the Godrej Group is split into two. One is Godrej Enterprises Group and Godrej Industries Group. And Godrej Industries Group will have 5 listed companies, including Godrej Consumer, Godrej Properties, Godrej Agrivet, etc., which will be led by Nadik Godrej and Adi Godrej. And in the case of GEC, which is Godrej Enterprises Group, will be headed by Nairika and Jamshed. And both companies, both groups can use Godrej brand name, which is one of the fabulous thing about this deal. And in the case of Adi Godrej, who was like a face of Godrej Group all the while, he had stepped down from executive chairman position in 2021, and his son Firoz Shah Godrej will take over from Nadik Godrej from 2026. So from what we are getting is like from all aspect, it is very amicable and very decent a settlement. And what we pick up, the reason behind the rationale behind this setup is, one is to make their strategy very clear, and they don't want to spread too thin. They want to make best use of the management bandwidth, and they think that this will give more clarity for the goals, and we can expect more listing from the GEC group as well at this point of time, Paul.
Does sound an awful lot like sorting out some family politics. What do analysts think about this move?
So they're thinking that there's more clarity to the group because, you know, under Godrej Industries Group, there are 5 listed companies and they are planning to list more companies as well. So with this clear kind of a split, that too without any fight, they think that the management could be now get into more, development areas. Like, for example, Godrej Enterprises Group, they have 3,400 acres of land in Mumbai, prime land to develop. So one group can now focus on developing those prime properties in Mumbai. And Mumbai is like, when it comes to land, it's like really a priced asset. So both companies and both listed units and all unlisted companies can now focus on their work, and they can develop or they can make this conglomerate, both two different units, into greater heights. That's what analysts feel at this point of time.
All right, Bloomberg conglomerates reporter P.R. Sanjay there. Thanks for joining us on the breakup of Godrej. We have plenty more to come. This is Bloomberg. Here's some of the top finance stories that we're tracking today. DBS's first quarter profit rose as it continued to benefit from higher lending income and strong wealth management fees. Net income expanded 15% to $2.2 billion. That beat analyst expectations. CEO Piyush Gupta says the bank saw momentum across the business and highlighted that Treasury customer sales also reached new highs. National Australia Bank says it's going to buy back up to $1.5 billion Australian dollars of its own stock. The lender's cash earnings fell 13% in the 6 months ended to March 31. CEO Andrew Irvin says disciplined execution of strategy helped the bank manage the impact of slowing growth and competition. Irvin took charge of NAB last month and appointed Rachel Slade to head the firm's business bank. The former Societe Generale trader in Hong Kong claimed he was fired after the bank found risky bets that went undetected by its risk management systems. It comes after Bloomberg earlier reported that Kavish Kataria and another trader left after an internal review of transactions that could have caused the lender hundreds of millions of dollars in costs. All right, let's take a look at how the market is trading. We're seeing Hong Kong performing pretty well at the moment, but some of those banking stocks also doing well. DBS, who I mentioned, up 2.2%. The National Australia Bank liking shareholders liking that story as well. Standard Chartered, we're going to hear from them in a moment, reporting first quarter earnings a little later. That's it from Bloomberg Markets Asia. Daybreak Middle East and Africa up next. This is Bloomberg.